Good afternoon, everybody. This is Brian Dewhurst with Uncommon Wealth Partners, bringing you the mid-January market update and Bitcoin briefing. So, Philip and I just wanted to say we hope you had a Merry Christmas and a Happy New Year, and that 2018 is off to a phenomenal start. And with that, the markets are off to a phenomenal start. So let's dive in. The S&P 500 is at 3.35 already in about 12 days. NASDAQ up 3.63, Dow Jones 3.94, Bitcoin up 4.38, and gold up 1.76. I've added gold because, like I said in the last video, I think it should have a good year, and we're going to continue to talk about money and the 7 sources of residual income on our podcast, and gold is money, so we're going to keep talking about it. All right, let's keep going. This is the S&P 500 index. We've got blue candles above the white line. All of our indicators here, 6 green dots, and blue candles look positive. And some of you have asked, what does this mean? Like, what do blue candles mean? What does this mean to me? So the reason we're looking at this is because we want to see if there's a change in sentiment. So what we're looking for really is like in here, where the red candles are saying, hey, this trend is changing. We got a red arrow, which just means we're reverting to the white line. And then the red candles are saying, hey, the momentum is shifted. You see the red dots in here picked up, and you see the blue was waning down. And so this is really how we're using this chart to see, is something changing? Should we be more cautious about our exposure to the stock market? And now you go back here, like the financial collapse, red arrow, red candles broke through the white line, and we kind of fell apart, right, over several months. And then you see down here, these all went red. So what we're using this chart for is we're trying to see, do we have red candles or blue? Well, we have blue, so that's good, and we're setting all-time highs. Do we have green dots or do we have red dots? We have all green dots. Do we have teal bars that are increasing, or do we have, darker blue columns that are decreasing? Well, we have teal that are increasing. So all of these are positive right now based on the data. I'm looking at the data historically, but we're looking for that to change. And really, since we started the YouTube video, it hasn't changed. It's been pretty easy, right? The market's gone up, and that's good for us. So, but that's how we're using the chart, and that's what we're looking for is it changing trend? All right, this chart, we showed this to you before in the past. Green candles up, setting all-time highs. Our red shorter-term average, moving averages are fanned out. Nice gap there between the shorter term and the longer term. That's intentional. And then those are fanned out. So what are we looking for in this one? How do we use this one? Well, what we're looking for is where the price or the candles are breaking through the shorter term moving averages. And then you see the price breaking through the longer term moving averages. And then you see the red lines breaking through the blue lines. That's showing you that like things are falling apart in the stock market, and you should expect downside. And maybe we need to change your overall portfolio to be more defensive or to move to cash. And those are the different conversations that we have individually with our clients, right? But do we see, as of today, January 12th, a change in sentiment? And do we see this rounding off or rolling over effect like we've seen in the past? No, we do not. So with that, the data suggests that we should still be probable or open to higher prices in the stock market. Now, with that, obviously, there's a lot of things I think in 2018 that could present headwinds, and we'll talk about that. But as of right now, on January 12th, those aren't showing up on the charts. Last slide on the S&P 500. This is our red light, green light, yellow light chart. I don't know how else to call it. It's called the 10X bar is the actual indicator, but I think, we're all familiar with red light, green light. So do we have green candles making new highs? Yes, we do. That's bullish. And in the past, that's represented, the kind of the final part before a trend exhausts itself is these green candles. And so what are we looking for, or what does this mean to me? It means we should stay open to higher prices. We don't see any red. We don't see any yellow. And typically in this chart, looking out 20 years, the S&P 500 the green candles have only been followed by red. I think every time it's been red. So what are we looking for? We're looking for red candles to say, has the trend shifted? Do we need to be more cautious? Do we need to be open to now lower prices instead of higher prices? And do we need to change anything with our portfolio, or should we be changing things for our overall plan? And so that's why we're using these charts, and that's what we're trying to communicate to you by showing you this stuff. But as of right now, things look positive and healthy, and we should be open to higher prices. But we're going to keep analyzing this because that can change on a dime. And so we want to be cautious of that. All right, gold. So we are going to talk more about gold. Gold has been around for 10,000 years. It's been around every, documented society in the known world forever. Every society has used it as a store of wealth, as an adornment of jewelry or prestige, or as money or currency. And so it is, in my opinion, the best form of money, and we'll get into that over time. But for right now, this is the GLD. This is the ETF that tracks gold, or the spot price of gold. And you can kind of see here, the thing I like about this and why I wanted to show this to you today is because, as we've looked at the S&P 500 and the broader markets, even the NASDAQ, since we've started the channel, it's just been straight up. And so there hasn't been much else to look at. Gold, on the other hand, has been in a downward trend for a long time. And we're seeing that trend, I think, shift. And I wanted to walk through that on the chart with you so we can see, different patterns and different asset classes doing different things with the indicators. And so you kind of see here, we had red candles. You see 3 green arrows. I mean, this is a 5-year downtrend. Now we're seeing blue candles in here, then red. Now we're back to blue above the white line, which is kind of what we talked about in the S&P chart. And now we're getting more green dots instead of red. Not only this, our squeeze indicator is firing red, and we're getting teal candles that are increasing. Now, what does this mean? What does this look like historically when we've seen this shift? So here we had blue candles, we had red, and then back to blue above the white line. We had the red turn more to green. We had a squeeze move into increasing teal columns here, showing us all those lines, showing us we're going to have more momentum, or we should be open to more upside in the price of gold. So I think in 2018, we need to be more open to the upside of the price in gold. In this chart, the data is suggesting that that's accurate. So looking at things from a macroeconomic standpoint, we showed you last time the governments all over the world, not only our government, but all governments, are printing massive amounts of money. And so we're seeing, I heard the term this week, and I was reading an article, and I think it's poignant, is called the everything bubble. Everything is going up right now because there's just been a complete flooding of cash to the global economic system. And so you're seeing cryptocurrencies almost approaching $1 trillion market cap. You're seeing commodity prices are set, I think, to go higher this year as we see inflation pick up, as global economies are expanding. That means, more countries are using oil. And you're seeing the stock market make all-time new highs, and you're seeing real estate at all-time new highs. And so it's called the everything bubble because they've just printed a ton of money. So we want to be mindful of what different asset classes are doing and how they're responding to this creation of money. So with that, that's our gold chart. And now let's talk about Bitcoin. So Bitcoin's obviously pulled back. The big question is it a bubble? Like I addressed in the previous video, I don't think it's a bubble that's like invalidates the technology and we're never going to use cryptocurrency. I think it's actually the opposite. We just saw in the last 2 weeks, a big company called MoneyGram. They transmit money all over the world. MoneyGram just partnered with a coin called Ripple. You're seeing Israel came out and said, hey, we're looking at cryptocurrency for our national currency because 6 to 10% of our economy is conducted in the black market, and we can't track that. You're already seeing Venezuela, their economy is falling apart. Their president just came out and said, hey, we want to do an asset-backed cryptocurrency to stabilize our currency system here in Venezuela. So you're seeing companies adopt cryptocurrency. You're seeing countries now talking about adopting cryptocurrency. So that to me validates the technology. With that, obviously we had to have a reduction in price. The price went from 1,000 to 20,000. So I wanted to show you a chart. This is when Bitcoin went from $25 to $1,000 back in 2013. And on a percentage terms, very similar to what we just experienced from 1,000 to 20,000. After that peak here of about 1,200 or 1,100 or whatever it was, we saw a downward negative trend, kind of like we just saw in gold, and then a basing down here where it really just flattened out. And then we see this green candle and it just kind of breaks out to, set new highs. But this top was put in on November 1st, 2013. And we see this candle you see down there, October 1st, 2015. That's 23 months that it traded in a negative or flat pattern to consolidate those gains of it going from 25 to 1,000. So what we're seeing in Bitcoin right now is just that consolidation of gains, that negative to sideways trading pattern that we saw 2 years ago. I don't think Bitcoin's going to trade sideways to negative for 2 years, but I do think it's going to take some time in the short term for those gains to be consolidated and this pattern to establish itself. So as we look at where Bitcoin's at today, you kind of see we're trading in this range between 16,500 and really 12,000. And so we should see a negative trend, kind of like that, consolidating sideways and down, I'd say for the next 3 to 6 months, depending unless something happens that spurs more people to get into Bitcoin and something major changes globally. But we should see a consolidation of those gains and a sideways to negative pattern emerge as Bitcoin, builds a foundation to go to higher prices. So with that, I think those are the main things we wanted to show you today. The markets look healthy, but in terms of headwinds, what are we looking at? What should we be mindful of? We're getting a new Fed Reserve chairman here in the next 30 to 45 days, replacing Janet Yellen. The Fed has stated that they want to push rates higher 3 times this year. You're going to just see a lot of talk about currency, interest rates, and different things because so much money is being created, and you've got Russia and China really taking shots across the bow at the US dollar. And so China just came out very recently and is stating that, we don't know how many treasuries we want to keep buying from the United States. Well, they own, over $1 trillion in treasuries. And so I think what you're naturally going to see, just because so much money has been created and it's going into real estate, it's going into the stock market and cryptocurrency and business in general, I think you're going to have to see rates rise to support the strength and the foundation of the dollar. Interest rates are a function of people's faith and belief in the dollar. And not only that, we just passed a tax cut amidst record deficits. Our national debt we showed in the last video was over $20 trillion. And so when we're going to run a $500 billion to $1 trillion deficit annually and add to that plus the interest we owe on the $20.5 trillion, we need to print money to pay for that because we're not making that money. And so I think you're going to see a pressure on interest rates to go up. That's not a function of the health of our economy. That's a function of the fact that the rest of the world and the people that are buying treasuries are saying, we need more yield to take this risk on because the stock market is at all-time highs. Cryptocurrency is exploding. Commodity prices are going to go higher. So the treasuries have to produce more interest to the people that hold them because they've got to get paid. It's just like an opportunity cost thing. They've got to get paid to hold those treasuries versus putting their money in a different asset class that might go up 5% or 10% over the course of a year. So when we look at liquidity around the world and we look at interest rates, I do think you're going to see the interest rates in the United States push up, and they are going to tighten their balance sheet a little bit, which will help the yield curve stabilize. So long story short, what does this mean for you? There's just going to be a lot more gyrations, I think, in interest rates, currencies, and Bitcoin, cryptocurrency, and gold because you're just seeing a shift away from the US dollar. And you're seeing a shift from these central banks from trying to print as much money as they've printed in the past. And so it's going to be kind of a dance to get that right. So that's kind of what we're looking at. Again, I think we like the outlook of 2018, but I think we're going to see more volatility in 2018 than we've seen in the past. And the reason we shoot these videos is to look at that volatility on the charts and see what the data is telling us as opposed to maybe headlines, that type of thing, and seeing how the markets and these different asset classes are responding to different things that are happening in the world. So we're on top of things. We want you to continue to join us with this video. If you find it useful, please smash the like button and subscribe, and we will give you another update here at the end of January. Thanks for watching, everybody. Bye-bye. The material in this video has no regard to the specific investment objectives, financial situations, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell a security or any other related financial instruments. Nor should any of the content be taken as investment advice. Any of the opinions expressed in this video are subject to change without notice, and Uncommon Wealth Partners LLC is not under any obligation to update or keep current the information contained herein. Uncommon Wealth Partners LLC and its respected officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. Uncommon Wealth Partners does not accept any liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.